London Gold Fix. It's the benchmark used by miners, central banks, and jewelers to value the metal. However, according to two researchers, it may have been manipulated for over a decade by the 5 banks setting it. Today on Kitco News, we have an exclusive interview with one of the researchers behind the study that's set to be released. Joining me from New York now is Rosa Abrantes-Metz. Thanks for being with us.
Thank you for having me today.
So Rosa, when your preliminary study came out a few months ago, it caused a lot of waves in the industry. Now your full study is set to be released, correct?
I hope so. I still do not exactly know when.
So let's get right into it, Rosa. We know from reports that your research focused on the trading patterns around 3 p.m. in London when the so-called afternoon fix is taking place. What is it that you found exactly? What irregular trading patterns did you see?
So the paper that was mentioned, we look into the spot prices for gold from 2001 through 2013. And we tried to measure the times of the day in which prices jumped the most by looking into price movement on a particular minute compared to where prices were before and after it. We find that particularly since 2004, the incidence of large spikes in prices for spot gold has very significantly increased for the PM fixing. Though that incidence was not particularly large prior to 2004, and with respect to the AM fixing has not really changed very much throughout the period. Very often, those changes in prices, those price jumps, are the largest of the day, larger than even when New York trading opens.
Rosa, I'd like to stop you there and just bring up 2 points now. You mentioned 2004, but in 2004, we saw substantial changes in the gold market. We saw gold ETFs get started in 2004. We saw gold prices rallying. We saw mining companies ramp up production. We saw investment demand increase. And in terms of the afternoon fix in London, it tends to see a lot of producers selling because it occurs when the Americas are open. So could these factors not have played a role in this unusual behavior?
As I was saying, they may help explain some of the price spikes we observe, but they also, again, increase the incentive to cheat. Presumably, gold companies sell their additional productions on the fix through the banks. The banks know these orders ahead of time. They know when there's a lot to sell. They may have an incentive to try and move the price, particularly downwards on days in which the selling occur, if they happen to be on the other side, for example. Or if they have very large positions on derivatives for gold, they may have an incentive to move prices one way or another to benefit from positions on those trades, on those derivatives. This is not novel. We have seen these obviously in LIBOR and Euribor. On the one hand, those structural changes could help explain to some extent some price movements, but they could also be causing those price movements because they increase the incentive to cheat because the gain is larger.
Rosa, what inspired you to look at the gold market?
The gold fixing has most red flags that significantly increase the likelihood for abuse. The most important, in fact, is that it is set by a very small group of players who enter into a direct exchange, a call on what prices should be, and that exchange is not released to the market. To my knowledge to date, I do not think any of these calls are publicly released. So when we have a small group of players directly interacting on what the price of a good they have direct interests will be and on which multiple other financial interests, such as gold derivatives, are benchmarked, in a market where there's no need to do so because there's enough trades daily to base benchmark on those trades, and they completely lack oversight of what's going on in that benchmark. All of that together raises significant amount of red flags and deserves, in my opinion, further investigation.
Rosa, there's one thing I would like you to respond to and give you an opportunity to respond to directly. A lot of people would say that you 110% believe that there's gold manipulation occurring. Is this an accurate statement?
No, that is not correct. I have never stated that. What I believe is that the patterns are there that are consistent with a price that on some days doesn't seem to be a price driven by normal market conditions. When you couple that with the structure of the fixing itself, as I mentioned earlier, and the knowledge that similar type of behavior has occurred in other markets, then there's a certain level of likelihood, in my view, high, that wrongdoing may have occurred. But I am not 100% sure.
Rosa, and from what I understand, your research is being used in lawsuits against these 5 banks?
People are free to use however they want the research that I put forward. But yes, I have been retained by a law firm to work on this matter.
Rosa, once you're done your research with the gold market, do you plan to look at other markets such as silver?
Many other markets are potentially of interest to me, yes.
Rosa, thank you for joining us for this exclusive interview.
Thank you.
And thanks for watching this edition of On the Spot. You can email us at newsfeedback@kitco.com. Have a great week.